Welcome back, everybody, for another deep dive. This time, we're going to be tackling something that I think you're particularly interested in, and that is balancing return potential with risk management when building your portfolio. And we've got some fascinating sources on risk parity portfolios. And then on top of that, to make things even more interesting, these sources propose combining that with leveraged ETFs.
Yeah. Risk parity is really interesting because it kind of like shifts the focus. It shifts it away from just chasing the highest possible returns, and instead it tries to spread the risk more evenly across different asset classes.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
It's kind of like you think about a well-balanced team.
Yeah.
Every player contributes to the stability of the whole team.
Right.
It's not relying on like one star player to win the game.
Yeah, so instead of trying to pick the winners, you're kind of strategically diversifying.
Exactly.
To make the portfolio less susceptible to the fluctuations of any single asset.
Exactly.
Oh, very cool. And that's where the leveraged ETFs come in. I'm guessing these are meant to amp up the return potential,
right,
even with this more balanced approach.
Yeah, so they use derivatives to magnify the potential returns.
Okay.
Sometimes it can be like 2 or 3 times the underlying asset's performance.
Wow.
But it's important to remember that it goes both ways. They amplify the losses too, so you really need to be careful with leveraged ETFs.
Okay, so high reward, but also high risk.
Right.
The Quant Connect source actually lays out a sample portfolio using this strategy, and they propose using TQQQ for U.S. equities alongside SVXY and VXZ, and those are short and long VIX short-term futures ETFs.
Okay.
Then there's TMF for long-term bonds, EDZ for shorting emerging market equities, and finally UGL for gold. It's a pretty diverse mix.
Yeah, and you can see that this mix is chosen for a specific reason.
Okay.
So you've got things like U.S. equities and long-term bonds. They traditionally have like an inverse relationship. So when one goes up, the other one tends to go down. And that negative correlation helps to cushion the whole portfolio against major swings.
I see.
And then you add in stuff like gold,
Okay.
which often moves independently of both of those.
Gotcha.
So you're getting another layer of diversification.
So even if one part of the portfolio is taking a hit, the other parts might be holding steady or even gaining.
Exactly.
So it minimizes that overall impact.
Yep.
The source even mentioned something that you brought up earlier, and it's kind of like diversifying your college applications.
Right.
You're not putting all your hopes on one single outcome.
Exactly. And there's another really interesting potential advantage with this strategy. And that's that it tries to capitalize on the shifts of capital flows between different asset classes.
Oh, okay.
So, for example, like when investors get nervous about the stock market, they often move their money into bonds or gold.
Right.
And then a risk parity portfolio with leveraged ETFs could actually see magnified gains in those areas.
Oh.
So you get this compounding effect as the money flows in.
So it sounds pretty promising, but I know there has to be a flip side to this.
Oh, yeah.
The source makes it clear that this isn't some magic bullet.
No, it's definitely not. One of the biggest things to remember is that leverage is a double-edged sword.
Right.
It's going to multiply your gains, but it's also going to amplify any losses. And leveraged ETFs usually have higher expense ratios compared to their non-leveraged counterparts.
So while you're aiming for these big returns,
Yeah.
you need to also be prepared to potentially have big losses.
Right.
That's a pretty significant risk to consider.
It is. And it really highlights the need for a very thoughtful approach to risk management with this strategy.
Okay.
And that's why the source raises these interesting questions about using variance as the sole risk measure, because it might not really capture the full picture of the potential downsides.
Especially with the leveraged ETFs.
Yeah, especially with those.
So if variance isn't really giving us the whole picture, then what are some other ways that we can measure risk when we're dealing with a portfolio like this?
Well, the source mentions conditional value at risk, or CVR.
Okay.
And unlike variance, which just looks at the spread of potential outcomes,
Yeah.
CVR is specifically focused on the losses that could happen in those worst-case scenarios.
Oh, okay.
So it kind of gives you a more realistic understanding of how much you could actually lose if things really go south.
So instead of just seeing how much an investment might fluctuate up or down,
Yeah.
CVR helps you understand the potential magnitude of those downswings,
Right.
which is really crucial when you're dealing with those leveraged ETFs that can magnify your losses.
Exactly. And it also brings up this other really important concept called volatility drag.
Okay.
So even if your investments are trending upwards over time,
Yeah.
all those frequent ups and downs can actually eat away at your returns.
Oh, really?
Yeah. It's kind of like imagine a boat that's trying to sail against a strong current. Even if it's moving forward, the current's constantly pulling it back, so it slows down its progress.
Even if a portfolio is technically gaining value,
Yeah.
that volatility is going to kind of eat into those profits.
Exactly. And that's where the strategic selection of ETFs comes in, especially those with negative correlations.
Right.
It becomes even more important,
I see.
because by including assets that tend to move in opposite directions,
Right.
you can potentially smooth out the ride a little bit
Yeah.
and mitigate that volatility drag.
It's about finding those strategic pairings that can help you balance out those ups and downs
Right.
that are inherent in any investment strategy, especially one that's involving leveraged ETFs.
Yeah, for sure.
This is all fascinating stuff, but I want to make sure that we connect it back to our listener.
Okay.
So, what are some practical steps that someone could take if they're intrigued by this risk parity approach with leveraged ETFs?
Well, first and foremost, I got to emphasize that this is not a set it and forget it kind of approach.
Right. This requires research, careful monitoring, and probably some frequent adjustments.
It sounds like it's not really for the faint of heart,
No.
or those who are just looking for a passive investing strategy. But for those who are willing to put in the time and the effort, it could be a way to achieve higher returns while also managing risk in a different way.
Absolutely. I mean, the first step would be to really research all the different leveraged ETFs that are out there. Understand their underlying assets,
Right.
their expense ratios,
Yeah.
and how they've performed in the past.
So no jumping in head first.
No, definitely not.
You really got to do your due diligence and understand what you're getting into.
Absolutely. And that's where back testing can be super helpful.
Yeah.
There's all these online tools and platforms now that let you simulate how different portfolios might have performed in the past.
It's not a guarantee of future results, but it can give you a better sense of how things might behave under different market conditions.
Right. So that sounds like a really crucial step to gain confidence in the strategy and see how it aligns with your own risk tolerance.
Yeah, exactly. And speaking of risk tolerance, that's another key thing to think about.
Right.
Are you comfortable with the idea that your gains will be bigger,
Yeah.
but also your losses could be bigger?
Yeah.
Because this strategy is going to be more volatile than a traditional, more conservative approach.
Because let's be honest, not everyone's cut out for that level of risk.
Right.
Some people might prefer that slower,
Yeah.
more stable growth path.
Exactly. It really all comes down to your individual goals,
Right.
your investment timeline, and how much risk you can actually handle.
Yeah, this has been a really in-depth look at a complex but potentially very rewarding strategy. So before we wrap up, are there any key takeaways that you want to make sure that our listener walks away with?
Oh, yeah, for sure. So first, remember that risk parity is all about balancing risk. It's not about getting those highest possible returns.
Right.
It's a totally different mindset than traditional portfolio construction. And second, leveraged ETFs can be really powerful tools.
Yeah.
But you have to remember, they come with risks. You really need to understand how they work
Okay.
and be prepared for the possibility of those magnified losses.
So knowledge and caution are paramount.
Absolutely.
You really got to understand the tools you're using and what the potential downsides are before diving in.
For sure. And then finally, don't rely only on simple risk measures like variance.
Okay.
Explore other methods
Yeah.
like CVR to get a clearer picture of what those potential downsides could be.
It's like upgrading from a basic map to a GPS system. You want the most accurate and detailed view of the terrain before you head out on your journey. It's like having that extra layer of navigation, to make sure you're aware of all the potential detours and roadblocks.
Yeah, that's a great way to put it. And the Quant Connect source actually left us with a really thought-provoking question about all this. They point out the potential limitations of using variance as the only risk measure,
Yeah.
especially when you've got leveraged ETFs involved.
So to wrap things up, let's pose that question to our listener.
Okay.
Considering those limitations, what other risk assessment methods might be worth exploring when you're building a risk parity portfolio that uses these leveraged ETFs?
Well, like we talked about, CVR, that focuses on the potential losses in the worst case scenarios.
Right.
That could be a valuable tool.
Yeah.
It gives you a much more realistic picture of that downside risk than just using variance by itself.
And maybe even going beyond just specific metrics. Like what about stress testing the portfolio? Seeing how it might perform in like a recession or a time of high inflation or even a sudden market crash.
Yeah, that's a really good point. Because remember, risk assessment, it's not like a one-time thing.
Right.
It's an ongoing process,
Yeah.
especially with a strategy like this.
Right. As markets change, our understanding and management of risk needs to also change.
It's like checking the weather forecast before you go on a hike. Conditions can change really quickly, and you want to be prepared so you can stay safe and actually enjoy the journey.
Exactly. The world of investing, it's dynamic.
Oh, yeah,
The tools and strategies we use have to be just as adaptable.
for sure.
So it's all about staying informed, being flexible, and always learning and evolving your approach.
I think that's a great way to put it.
Well, we hope that this deep dive into risk parity and leveraged ETFs has given you some things to think about. Maybe sparked some new ideas for your own investing. Remember, knowledge is power when it comes to making smart financial decisions. Until next time, keep diving deep and exploring.